Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. Good afternoon, everyone. Thank you for joining my Tuesday session. My name is Lakshay. We're going to be talking today on how you can earn an additional 15% if you are a realtor or a small business owner. So without further ado, let's get started. I wanted to highlight a new concept which most of you might have been familiar with, but I wanted to still cover it because it can be really worthwhile for someone who hasn't experienced or don't know about it. So what is private lending? Private lending is a way where you lend your money privately and earn some extra interest. It could be secured against a mortgage, or it could simply be on a promissory note on a simple interest to a friend or family member. Today's topic, I wanted to highlight how you can earn an additional 15% by private lending. Yes, you heard it right. The market rate right now would be 4.5% based on the bank. The commercial rate would be 4.5 plus 2%, which is roughly 6.5, 7%. But with private lending, you have the opportunity to earn as high as you want. The ceiling is yours. The funds can be given for a short-term loan or a long-term loan. That can be decided based on whatever you decide. You may have clients who have run into a situation where at the time of closing, they're short of funds. At that time, private lending works beautifully because in this scenario, this person wants to close. They're willing to, they might need a short-term loan because they have some funds coming up from overseas, from a family member, from their parents, or inheritance money. But right now, they're short of that last $50,000, $60,000, and now they need to close on their house. So what is the solution? The solution is give them a private loan on an interest rate that you can mutually agree on. So sometimes I've seen people agree on a mutual interest rate as high as 22% and as low as 12%. If let's assume you have a family member that you are trying to lend it to, you might not want to charge them a lot of money. You just want them to have the funds for 6 to 8 months, and you shake on it and you lend them on based on the market rate, which might be 5, 6, 10%. But once you're doing a private lending loan, this is a little bit more formal because over here, you can also register a lien on their property. So let's assume you loan me money and you might not know me that well. So you need some security. You want to secure the loan against an asset. So the best way to do that is lend it to me by putting a lien on the property as well. So we're going to go take a deep dive as to how you can earn that additional 15 to 20% if you are in the market, if you have a business, or if you have some cash reserve that you're sitting on. So mostly private lending loans are secured against a mortgage or a property. The lending fee, the beauty of it is you charge interest rate, which is normal, as well as lending fee. So it can give you a good return because lending fee could range from 5 to 7%. And your basic interest rate might be 12%. So 7% plus 12% is an amazing return if you ask me in today's market. So what are some of the due diligence? What should you consider when you're lending money? Whenever you're considering to lend money, is it right for you, first of all? This is technically right for people who already have a retirement saved up, they have some passive income coming in, or they're looking for an additional source of passive income. You have a family member or friend who's looking to, close on their first home and they're short of funds. So you want to lend them some additional money and as well as get a profitable return out of that as well. I've seen because I prepare taxes, I've seen a lot of lawyers and doctors, they have a lot of big cash reserve from savings. And this can be a great way to kind of increase their return on their investment, return on their cash. Instead of just depositing in a GIC, you can now lend it to an actual person who will, pay you a very good and hefty return. Especially for real estate investors who have cash, they're looking to get some additional money. This is a beautiful option for them. So why private lending? Well, the idea behind this is it's short term, right? You get a quick return on it. It could be for 6 months. It could be a 1 year. So they're short-term loans. So you're not basically tied to a 5-year plan. You need to basically assess the borrower's ability to pay you back. There are two ways of, lend your money. You could do it through promissory notes, which is unsecured and not so safe, but it is meant for people who are doing it for their family members. Number 2 is second mortgage commitment letters. This is a little bit more official way. You might have to involve in paralegal to do the right thing, put the lien on the property, as well as, collect interest and lending fee. So let's get into that. What are the advantages of private lending? Private lending, you don't have to deal with tenants and toilets. You giving money on interest, so you don't need to worry about the property and the problems that comes with owning a rental property. The term of the loan is actually short, so it's really good in terms of to get a quick cash flow. The third point is interest income. Not only are you earning the basic interest, which might be 12%, you're also earning 5% on top of it based on however much you have agreed upon with your borrower. Number 4 is some private lending loans are secured against property, so it's completely secure. Whenever you're lending money, you would want to be in a situation where you are secured. So in private lending, the amazing part is you are secured against a property. So if someone, let's say, were to default, your name is still on that property. Because now your name is on that property, you are able to technically be on the second position. What's the worst that can happen? The bank will go in, they're going to sell off the property. When they sell off the property, because you are second to the title on the property, you will be also given a call and your loan would be paid off at that time. Let's now talk. Now we've talked about what are the advantages of private lending. The advantage is simply the cash flow. Now let's look at the potential risks. What are some of the risks to going into an arrangement like this? You really need to check the borrower's ability to pay the loan with the interest, right? Because at the end of the day, I know it looks good, nice to have all of the money coming in, but if the person is not able to repay you in time, that's a big problem. This is something that you need to have an exit plan, a repayment option, the fair market value, and the location of the property that's used as a security. Sometimes what happens is in the market where the property prices were going down, if you're on the second position, so let's assume it's $1 million house, right? You are on the second position because someone took a second mortgage from you. The first person is technically the bank. So if they sell the house for, let's assume, 1.1 million and the outstanding loan is 800,000, the first 800,000 would technically go to the bank, and whatever is left over between 1.1 and 800,000 would technically pay off your second mortgage loan. But what happens if the property price went below the market value? If, let's assume, the property price dropped from $1 million to 800,000 and the bank went in to sell the house and $800,000 was the recoup that they got, and the outstanding mortgage was also 800,000, unfortunately, you're on the hook now that you would technically not be getting paid anything. So the risk over here is potentially losing all of the investment as well as the interest if you basically get into an agreement with someone who is not able to basically pay you back. So something to think about in that scenario, that when the market is going up, private lending makes sense, but market crashes, there might be a problem when it comes to selling the house when the fair market value has dropped. So market crash will technically wipe out your equity. That's why we kind of suggest that whenever you are on the second position on any property, try to be at least at 70% loan to value or 80% loan to value, meaning that 20% over there is already safe, 20 to 25%. So if there was a market correction of 10 to 15%, you still have the remaining 10% to work on in terms of recouping your money. So how does it work? So let's assume Bob has a closing coming in for his resale investment property in 1 week, and he's short of funds of 60,000 and he needs to borrow it privately. In this scenario, what you can technically do is you can either write a promissory note with a family member at a 12% interest rate. So basically, you're going to lend them 60,000 and they're going to pay you monthly interest. This monthly interest will technically work out to 7,200 in the year, and divided by 12 months works out to $600 a month. So on this $60,000 loan on a promissory note, you are entitled to earn $7,200 in interest throughout the year, which is paid monthly to you in $600 installment. The second option is second mortgage. If you lend it out as a second mortgage, what would be the impact? So promissory note, we talked about $60,000 loan, 12% interest, 6 months term, you're getting paid $600 a month. Whatever the principal balance of $60,000 is, at the end of 6 months, they're going to pay you back the full amount. This is typically meant for family members. This is not meant for people who you don't know, because promissory note is not secured against the property. It's more unsecured. It's more for family members. Someone is looking to close on their house, your cousin, your nephew, someone who needs the immediate funds to kind of successfully close on their real estate transaction. Now let's look at a secure option. The secure option is second mortgage commitment letter. In the second mortgage commitment letter, you are technically giving $50,000 as a loan. Same thing in the previous example, but in this case, you're charging interest as well as lending fee. So over here, you're recouping 12% plus 5% lending fee. In this scenario, the term was still 6 months. The monthly payment is still $600 a month. The 5% lending fee, the additional money, you technically, when you're writing a check to them, you're writing it for $57,000 instead of $60,000, because the 5%, you basically earned that at the beginning of the show. Although the loan amount was $60,000, when you're writing them a check, you cut the 5% lending fee and then you write them a check for $57,000. This is a little bit more secure because you would want to contact a paralegal or a lawyer to register a lien on the property and basically make sure that the property value appraisal is right, the 85 to 75% loan to value is existing there, because otherwise it could be a problematic situation if the market dropped and there wasn't enough equity on the house. So it's always also a good idea, if you're going into behind a property on a second mortgage commitment, drive to that area, check out what the property looks like, fairly assess what the fair market value is. Sometimes people rush into things by looking at the interest rate and the ability to earn that passive income, but you go to the property and the house is just not worth that much. Also, I also suggest is whenever you're getting the appraisal value, get it from an independent party, because if you're getting it done from the same person who is doing the mortgage, they kind of have a conflict because they want the mortgage to go through to deal to close, right? So sometimes the appraised value with the mortgage, the people who are hired by the mortgage people, there might be a little bit of bias there. So something to think about when it comes to, this is just a disclaimer. Whenever you are going into this kind of arrangement where we're lending privately, drive to the property, check it out and see how it looks. And, then make a fair assumption as to what should be the market value and how much money you are able to lend. I wanted to show you a comparison as to how much the property price would look like. We talked about two examples. Example number one was under the promissory note model, where you're lending $60,000. The term was 6 months. There was no lending fee because you're giving it to a family member. It is unsecured because there's no property, there's no lien that you're putting. So it's unsecured mortgage, unsecured loan. You're giving $60,000 for 6 months at a 12% interest rate, would work out to $600 monthly payment of just for the interest portion. At the maturity, they're going to write you a check back for $60,000. So your total return in the promissory note example is $7,200, which is 600 times 12. Now let's look at the second mortgage commitment letter, where you are actually lending against a property. This is a secured loan. So if someone was to default, you would have still their house to go after. The loan amount is $60,000. Term is 6 months. In this scenario, you earn 5% lending plus the 12% interest rate. I assume these interest rates, these could be higher, lower based on whatever, in the market. I've seen people go as high as 22%, which is 12 plus 10. That's a little bit absurd, but I've seen that happen as well in the market. You have the opportunity to earn the additional 15 to 20% in form of interest. Under the second mortgage model, the payment is still $600 a month. Instead of writing a check for $60,000, which you did in promissory note example, you're going to write a check of $60,000 minus the lending fee. So 60,000 minus 3,000, you're going to write a check for 57,000 from the get-go. So lending fee you collected in the beginning. At maturity, he's going to pay you back 60,000, the full amount of the loan, and your total rate of return is $600 times 12 months, which is just the interest 7,200 plus the lending fee, which is 3,000. So it's 10,200. In this example, you are earning $3,000 more, and your house as well as your loan technically is secured. Something to think about whenever you're looking into an option where you're comparing the two. This is just an illustrative exercise where, it will change, the numbers will change if the term was longer, if the lending fee was, different. I've also noticed if someone doesn't pay within 6 months, this lending fee would renew. So 6 months later, he would have to again pay 5% lending fee. So again, very good option to earn additional money with the money that you already have in your prep. So now that we have talked about the two ways of, earning the passive income, which is, it could be from promissory note or it could be second mortgage commitment letter, you must be wondering that how should we do it, because we might have invested or our funds might be tied in a registered vehicle. It might be tied in an RSP, which is already, helping us reduce our taxes. So all of the funds surplus funds I had, it's already invested. So how can I, use those funds and use it towards the second mortgage? The best way to do that is, and that this is technically the final slide of the PowerPoint as well, is self-directed RSP mortgage lending. This is one of the ways that a lot of the people use their RSPs to invest through the bank. What bank does it based on your risk profile, aggressive, medium, or passive. They're going to put your funds into a mutual fund or a fund that is being managed by fund managers who will further invest it in the stock market. If you want it, you can actually self-direct your RSP funds and then invest it in where you want. So what I'm suggesting over here is, in summary, use your RSP funds and try to earn that additional interest by private lending. So now you must be wondering, the RSP funds cannot be used based on say it is actually not self-directed, it is actually done by the bank. How can we take control of those RSP funds? You can actually go to a financial institution that allows you to do self-directed RSP. In the self-directed portion, you first put money in the RSP, you get a tax deduction, and from the RSP, you lend it to whoever you want. In this way, you get to be the pilot of this plane and decide how much money you want to earn, where the money is being invested. Is it a good investment? Is it a bad investment? So this can technically help you yield a lot more, interest. I've seen the market, on average do 7-8%. But in this scenario, you can easily start off by 15 to 20%. So why not sit on the seat where you're in the driving seat and actually drive all of the returns yourself? That kind of wraps up my presentation for today. Thank you guys for listening in. For all of your taxation, accounting, and bookkeeping needs, feel free to reach out to me at my phone number or on my email, and I'll be more than happy to assist you.